All right. Good morning, Detroit, New York, California, Florida, Texas, Arizona, wherever you're tuning in from. It's 8:44 a.m. at the time of this recording. The coffee is not kicked in yet, and the market's pretending it's calm, and somehow we're still sitting within 3% of all-time highs. Because apparently nothing says healthy economy like consumers being miserable, housing frozen solid, a job market just limping along, and stocks going, yeah, man, but the vibes, they're good. Welcome to the final stretch of 2025, where markets are doing the financial equivalent of smiling through the pain like a guy who just pulled his hamstring but doesn't want to admit it. This is Trades and Gains, powered by Investor Central Club, and today we're breaking down why the market wants a Santa Claus rally, why consumers are salty as hell, and why inflation data gives the Fed permission to chill, and why big tech is once again duct taping this whole thing together. Let's go ahead and get right into it. So here's where we stand today, or as of Friday. The NASDAQ was up 0.4% on the week. The Dow was down 0.7%. The S&P 500, it was basically flat. And all three indexes, they're within 3% of all-time high records, which is wild when you remember consumer sentiment is near multi-year lows, housing is at a 25-year low, and half the country feels broke. This is not a bull market fueled by growth. This is a market fueled by liquidity, rate cut hopium, and people saying, well, where else am I supposed to put my money? And that's the key theme this week. Positioning is greater than fundamentals. Now, let's talk about the big thing here. Every year around this time, traders start whispering like kids on Christmas Eve, what if Santa comes early? Historically, the Santa Rally comes the last 5 trading days of the year, plus first 2 of January, one of the strongest windows in market history. And this year, liquidity is thin, volatility is compressing, and funds want to mark the books clean. Translation, nobody wants to blow up performance in the final week. That doesn't mean rip your face off rally. It means dips get bought, volume stays crushed, dealers stay long on gamma, and pain trades are even higher. But there's a catch, and that's consumers. And they're mad, and they're not wrong. So let's go ahead and talk about the elephant in the room. And no, I'm not talking about your sister. The consumer is pissed. University of Michigan sentiment, 52.9. That's down nearly 30% from last year. That's not meh. That's, I hate this economy, but my 401k is up. So I guess I'll just shut up. And this is where the K-shaped economy really matters. Top 1/3 of earners, they're driving over half the spending. Bottom households are living paycheck to paycheck. There are rising delinquencies, and rent is still crushing people. This is why headlines saying inflation is cooling don't really land, because CPI doesn't buy groceries or pay rent or fill your car up with gas. People do. And when food, energy, insurance, utilities, and services keep rising, nobody cares that the number printed 2.7%. Quite frankly, that's why you're seeing all these headlines that are saying economists are not sold on the 2.7% number we got from CPI in the first place. It's because people feel broke, and that shows up politically, and eventually that's going to show up economically. Now let's talk about the one thing Wall Street actually cares about, CPI. Because inflation came in soft. Headline CPI was at 2.7%. Core CPI is cooling. Shelter is slowing. And that's not just good news. That's Fed permission. The Fed already cut 75 basis points in 2025. And this CPI print says, you don't have to rush, but you don't have to panic either. That's why bonds stabilized, equities held up, risk assets breathed a little, but here's the reality. Inflation feels worse than it looks. And essentials, well, they're still rising. And sentiment doesn't heal overnight. So what does the Fed do? They slow cuts, they no urgency, and no pivot panic. And on top of that, we're going to get a rate cut monster with whoever Donald Trump instills into that position once Jerome Powell's done in 2026. But this brings us to big tech, aka the market's emotional support animal. Because let's be honest, if big tech sneezes, this market catches pneumonia. And this week, big tech showed up with tissues. Oracle, it's down nearly 40% from September highs. Then it popped 7% on TikTok deal headlines. Now why? Because suddenly AI spend fears paused. Cloud narrative got oxygen. And traders said, okay, maybe Oracle isn't dead. Even though most of those people can't even tell you what Oracle does. NVDA, it's up again after reports of the Trump administration reviewing chip export restrictions, potential H200 sales to China. In translation, revenue might not fall off of a cliff, and that's all NVIDIA needs to pump. And then we had Micron. We saw a 10% pop post earnings. It was confirmed memory demand is still alive and helped calm the AI is over fears. This isn't a broad market rally. This is selective confidence. AI isn't dead, but the market is done playing infinite multiples blindly. So be on the lookout for that. Now, this week's data, this is what actually matters. It's a holiday week, which means there's thin volume, weird price action, and headlines matter more than fundamentals. Tuesday, that's the big one. We have the Conference Board consumer confidence, we have durable goods, and we have core PCE, Q3 cleanup. If confidence ticks higher, well, the market keeps levitating. If it rolls over, expect a chop, not a collapse. And then on Wednesday, we have jobless claims, mortgage applications, and a half-day trading. Thursday, Christmas, so markets are closed. And Friday, well, it'll probably be crickets. This is a dealer-controlled market, and make sure you respect that. So how do you trade this? Well, what works? Range trading, short-dated calls on dips, volatility selling, and tech leadership plays. What doesn't? Chasing breakouts in low volume, over-leveraging into Christmas, fighting seasonality just to be edgy, and the biggest risk this week, overthinking it. This market wants calm, order, and no surprises. Save the hero trades for January. So here we are. Consumers are unhappy, housing is frozen, jobs are softening, inflation is quote-unquote fixed on paper, and yet the market is still standing. Not because everything's great, but because everything isn't collapsing. This isn't euphoria, this is controlled optimism. And as we head into the final 7 trading days of 2025, the goal isn't to get rich. The goal is to not do something stupid. Santa may show up, but he's bringing small gifts, not a new bull market. Stay sharp, stay patient, and remember, price over headlines, positioning over narratives, and liquidity over logic. This is Trades and Gains, powered by Investor Central Club. And make sure you like, subscribe, comment down below your hottest take of the week. And also make sure you subscribe to Investor Central Club, the best options flow software on the market today. I'll see you guys on the other side of Christmas.